Hey there, everyone. This is Tom Vilord from Wall Street Value, and today we're going over investment checklist tip number 6. We're going to compare the current price to earnings to their historical price to earnings, and this is one of my favorite ways to figure out where a stock should be trading at. So when we're doing calculations to come up with an intrinsic value for a company's stock price, there's a couple different ways we can do it, and some of those methods involve predicting what the company can do in the future. Now, that's not always an easy thing to do, so sometimes the best way to predict the future is to look in the rearview mirror. And one of the ways we do that is taking a look at where the price to earnings is of a company right now compared to its historical price to earnings. Now, PE, which is also known as price to earnings, also known as P ratio, and some people just call it the multiple. So the PE is how much an investor is willing to pay for stock relative to a company's earnings. The PE ratio is a widely used metric to determine how cheap or expensive a company is compared to its own history or other companies within the same industry. This term PE has been thrown around a lot, and I know most of you have probably heard the term before, but I'm willing to bet most of you probably don't really understand what it means or how to use it. So I'll give you a couple examples. A few videos ago, we used a lemonade stand as an example, so I'll do that again. And Joel Greenblatt used this example in his book, The Little Book That Beats the Market, and it was a really good illustration to understand how this works. We're going to use a lemonade stand to make things simple. We opened up for business in the beginning of the summer, and by the end of the summer, it earned $100. Now, if we wanted to sell that business for $100, we would be selling it at a PE of 1. What we're selling it for, which is the price of the business, is $100 divided by the earnings, which was $100. So that means the PE is 1. We wouldn't sell it for just 1 time's earnings. It doesn't make sense. We want to sell it for a few times its earnings. If we sold it for $300 to the enterprising kid next door, we would have sold it at a PE or a price to earnings of 3. Now, as a side note here, most privately held businesses get sold for a lower price to earnings, somewhere around 7 or 8 times earnings. Publicly traded companies, because there's a liquid market and it's easier to sell, they usually sell for a higher PE, usually around 15. As a seller, we want to sell it at a higher PE, but when we're buying a company, we want it to be lower. PE by itself doesn't really tell us much. Is 15 a high PE or is it a low PE? That would be a very high PE if we're comparing it to a utility company, but it would be a very low PE if we're comparing it to a technology company. The way we find this very useful is by looking at the historical PE of the specific company that we're looking at. If a historical PE for XYZ company is 20, and if the current PE for XYZ is 15, that could represent a bargain price. However, if the historical PE for XYZ company is 20, but right now it's at 25, that would represent an inflated price. Another way to understand this is to assume that you're going to buy an entire corporation, and we're going to buy this corporation for $1 billion. At a PE of 15, that's going to take you 15 years, assuming earnings grow at a rate of 0. So it's going to take us 15 years to get back your money from the earnings that XYZ is bringing in. At a PE of 20, it's going to take us 20 years to get back our original investment. We want to get our money back sooner than later, so a lower PE is better. And here's another way that we can look at it. Divide 1 by the PE. So 1 divided by 15 gives us a 6.6% rate of return on that billion-dollar investment. 1 divided by 20 is a 5% return on investment. I'd rather earn 6.6 instead of 5%. So again, a lower PE is better compared to its historical PE. Here's an example of how I used this last year, and this worked out really well. This chart here on the left, this is from a resource called Value Line, and if you guys want to use this, most libraries carry this resource for free. So I pulled up the Value Line report on Manpower. This is a really solid company. They have no debt. It's an A-rated company on Value Line. Their earnings have been growing pretty consistently over the last 5 years. And so I wanted to see what the median price to earnings is, what the historical PE is for this company. And I'll tell you why in a moment. So as you can see here up at the top where it says median, their median price to earnings is 16. And at the bottom, going back to 2011, their average PE is 14.36. So with that info, we can now determine if today's price to earnings is higher, lower, or average compared to historical levels. Looking at this last year when the Brexit occurred. when Britain decided they wanted to pull out of the Brexit, that caused this company to drop from $87 a share in the beginning of June 2016 to $57 by the end of June. And I'll show this in the following chart. But the reason why it fell so much, 65% of this company's revenues came from Europe. The Brexit caused a lot of uncertainty, a lot of fear, and so that caused this great solid company to go from 87 down to 57 in a month. At that level, so we've determined, let me go back to this previous chart here. Since 2011, the average PE was 14.36, but the median going all the way back has been 16. At the level right after the Brexit occurred, the PE was just 9.26. So if recent history says that a price to earnings of 14 is an average valuation, that's where they historically trade around, then buying at 9.26 is a huge bargain. So what we did, just to kind of figure out where this thing should be trading at, I multiplied the average PE of 14.36, and I multiplied that by the current earnings, which was $6.15. We came up with a target price of $88.31, and that's if this price earnings gets from 9.26 back up to average. So how likely is it that Manpower will get back up to a PE of 14.36? I got this chart here from S&P Capital IQ, and this shows us what the high and low PE is each year going back to 2006. And as you can see, it has reached 14.36 every single year from 2015 all the way back to 2006. With this information, I'm pretty confident that Manpower is going to get back up there. We're not asking this company to set a record high in terms of where the price of the stock's going to go. We just want it to get back to average. And if it just gets back to an average valuation, we're going to make a pretty good return. As of today, when I'm recording this, December 7th, 2017, Manpower blew past our price target of $88 a share. Right now it's at $125. So this worked out very well. Hopefully now you can see how valuable this information is. And now we can spot a good bargain by using historical PE and comparing that with where we are today on any given stock. We can also use this to spot terrible entry points. Or if you already own a company and it's at a pretty high valuation, we can determine a great exit point. Here's an example with Disney. Now, this is one of my favorite companies. I've always had a great experience there as a kid. The resorts are excellent. The movies are great. The customer service at Disney is amazing. It's just a perfect company in my eyes. But just because I love the company, I understand the business, and I have many positive experiences there as a customer. And it's not just me. Valueline gives them as an A++ rating. So it's a great company. But that doesn't mean I should just go buy their shares just because they're a great company. Because we could buy the greatest company in the world. If we're not buying it at a favorable price, we can still lose money. You can see here at the top of this Valueline report, their average price to earnings is 16. And if we go down to the bottom here, the 10-year PE and the 5-year PE is 16 and 17.58 respectively. So using the 5-year average price to earnings, the price target, 17.58 PE, and we're going to multiply that by the current earnings per share at the time, which was $5.73. That means that the target price on this stock is only $100.73. Knowing this information, why would anyone buy in towards the end of 2015 when the price to earnings was a staggering 24.89? So that's over 40% higher than the recent historical average price to earnings. If you bought at that point, you would be buying a $100 stock for $122. That's not a good investment in my eyes. Now, if you own it at those levels, that's a clear signal to sell. Now, let's go back here, and if you see where I circled in red, 2003, that was the last time Disney was as overvalued as it was in 2015. So you had to go back 12 years since the last time it was that expensive. So as you can see, you can buy one of the most solid companies in the world and still lose a lot of money if you're not buying it at the right price. Shockingly, Disney fell from $122 a share like it should have, down to a low of 86 in early 2016 before it started to come back up. It dropped because it was not worth $122. It reverted back to its mean, just like most incorrectly priced stocks do. I think the PE ratio is definitely a strong metric to look at, but keep in mind that it's just one out of several to look at. It's really good at looking at companies like Disney that have long track records, But when you're looking at a company like Tesla that's only been around for a couple of years, and they're garbage anyway, or Facebook, great company, but they've only been around, they've only been publicly traded for a few years. This metric isn't as good for companies like that. So that's why we have several metrics on our investment checklist that we like to use, and we use them all together. And it's also why we use 13 different ways to calculate where stock should be trading at. We're never going to use just one. And as great as this one is right here, it's just one of 13. We need to use them all together. So lastly, I do want to invite you guys to take our 16-week stock investing and options trading course. It's going to be 1 hour per week starting in January. So if you're interested in that, shoot me an email, tom@wallstreetvalue.com. And that's it for today. Thank you.